Hi, everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is your State of the Market. You know, the words volatile or volatility have a really negative connotation. Like if someone said, hey, that guy's really volatile, you probably wouldn't want your daughter to bring him home for Thanksgiving. Or if a stock is described as volatile, you probably think that you can't make money in it. But volatility doesn't always have to be so negative. Like that guy you wouldn't want hanging around your family might be a hell of a lot of fun to hang out with at a bar.
Hey, let's get hammered.
Well, I had an early day at work, so I probably...
Come on, I'm buying. Come on.
Oh.
Or a stock, you can actually make money on volatile stocks by trading certain options because volatility is an important aspect of options pricing. So depending on which way volatility goes, you can actually make money trading volatility. So don't always be scared off by volatility, particularly in investing. You can use it to your advantage, and I'll give you two ideas of how you can do that. The first one is beta. Beta is the measurement of how volatile a stock is compared to the S&P 500. Now, the S&P's beta is always 1. If a stock is 50% more volatile than the S&P 500, it will have a beta of 1.5. If it's 3/4 as volatile, it will have a 0.75 beta. Now, the idea is that if the S&P 500 moves by a certain amount, theoretically, a stock should move proportionally to its beta. So if the S&P rose 10%, a stock with a 1.5 beta should climb 15%, and a stock with a 0.75 beta should move 7.5% higher. Now, stocks can have negative betas too if they move in the opposite direction of the S&P 500. So a stock with a negative 0.5 beta should move half as much as the S&P 500, but in the opposite direction. So if the S&P rose 10%, a stock with a 0.5 negative beta should fall 5%. Now, if you can handle some risk, you may want to choose high beta stocks that should move more than the S&P 500 when the market does well, but keeping in mind it may fall more than the S&P when the market is falling. The more conservative investors would probably do the opposite. They would choose low beta stocks, knowing that their losses will be smaller than the broad market when it falls, but they won't have as large a gain when the market does well. Now, you can also use beta to choose stocks if you notice that the beta of your portfolio is getting too high or low. So for example, if you have a lot of high beta stocks, you may decide to add some lower beta stocks to even things out a little bit, or vice versa. Now, here's another volatility concept that has gotten a lot of attention lately, especially since the COVID crash, is the VIX, which is the CBOE Volatility Index. Now, the index measures volatility using the prices of S&P 500 options. So typically, when the market falls, volatility as measured by the VIX increases. And when the market is going strong, the VIX usually falls. Now, the long-term average of the VIX is about 20. So when the VIX is, let's say, at 30 or above, that's usually a rough time in the market. And if the VIX is below 20, things are usually going quite well. Market's rising. Now, when the VIX is at extremes, that's when you really want to pay attention. That is often a turning point in the market. So for example, when the market crashed in February and March, the VIX hit a high of 85. That was the highest level in more than 10 years since the financial crisis. And a week later, the market bottomed. Now, you can use that to trade. So you can trade options on the VIX. You can also trade ETFs and ETNs that are based on the VIX, such as the VXX. That's a very well-known one. For those that want even more action, UVXY is designed to move 1.5 times the performance of the VIX. If you want to bet in the opposite direction of the VIX, you can choose an ETN like SVXY, which moves 50% of the opposite direction of the VIX. So if the VIX fell 4% in a day, SVXY should rise 2%. So there's lots of ways to trade volatility rather than just trading stocks or a stock index. Volatility can be useful in your portfolio to better understand and control risk, as well as to trade it for profit. So understanding these basic concepts will make you a much better and more profitable investor.